Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Siding. We're doing a deep dive of Meta platforms today, and we are now moving into the actual valuation segment. Here we can see Meta's EPS growth year on year on a quarterly basis. And as you can see, they have pretty remarkable numbers, sometimes growing by 100 to 200%, but they also show a little bit of a cyclical, or at least an economic sensitive pattern with actually negative EPS growth numbers at times. The last year-on-year growth number on a quarterly basis was 51%. That's a huge number for such a big company, showing that they are able to grow really quickly despite their size. And that's interesting in terms of what we can project going forward. Here I've also included the annual growth numbers. The last 2 years have been 60 to 70% earnings per share growth, but that came on the back of a hugely negative year. So what we can say here is that Meta is able to grow really quickly. They have a huge follower base. They have more than 3 billion active users in their headcount. And the question is, how long can they keep this growth rate up? The analyst community, as we can see here, they are not convinced at all. They expect 2024 to be followed by just 4% EPS growth, and then around the 15% level going forward from there. I think that seems a little bit pessimistic. But on the other hand, there are headwinds in terms of regulatory threats, and also possibly a recession coming on the back of the ongoing tariff wars. So as you can tell, we need to incorporate analysis of a lot of external and internal factors for Meta to get this right. However, I think that given Meta's historical track record, given that it's a software and services company, given that they have a lot of high-end technology in the company, and also given their history of being able to use their user base for growth and profitability, and given that also that Mark Zuckerberg seems to be a super competent CEO, I think we're likely to in the mid to long run see much higher growth than the market is expecting. That is, however, more of a guesstimate than an actual forecast. But I think that this historical pattern here with more often than not 40% plus annual growth interspersed by only temporary negative years that are then followed by even higher growth, and these years 2020 and 2022 they were pretty unique in terms of negative environments from the inflation scare and COVID. So in any way, I think the pattern points to more of a 25% growth rate, and actually that feels a little bit pessimistic as well. But this year and next could actually be pretty far below the 25% threshold anyway. But we'll see how we can take that into account in our risk assessment later on. Any case, with 25% annual EPS growth, that means a doubling every 3 years. And that would take the EPS to for 2028 rather to a $50 level than consensus is $33. And at that time, having reported a $50 EPS, looking back to 25% growth and possibly projecting somewhere between 15 and 25% growth for earnings per share going forward as well. That points to at least twice the market average multiple. So let's say 30 times earnings wouldn't be a stretch at that time, looking back at that success record of 25% annual growth. So if we get these numbers right, we should be rewarded with a 30 times valuation backward looking. That is not much to ask. And that would take the price to 50 times 30, that is $1,500 per share, which is 175% more than today's level of 546, give or take. And that amounts to 40% per year. And actually they are paying a small dividend as well, so you can add a few percentage points there as well. The question then is, why is the market so pessimistic? I mean, with an outlook of perhaps 40% annual returns for 3, 4, 5 years, and that takes some explanation, and maybe there are things we don't really understand, or maybe the market is just being overly pessimistic right now. So for starters, a PE ratio backward looking of 23, that is actually very reasonable given the consensus forecasts of about 15% annual growth. It's actually bang in line, I would say. You can compare it to the market's 10% total annual returns and 15 times earnings. And this is 15% growth and 23 times earnings. So it's in that respect, the market is at least consistent. However, you could also say that even with just a 15% EPS growth, that means a doubling in 5 years. And that would take the 23 times earnings to just 11 to 12 times earnings in 5 years. And that would definitely be too cheap, of course, but then we also have to get to that point. So that would be 5 lost years to get it at 11 times earnings. Now let's look at what the market has typically historically awarded. So the first discussion part was how much, from an absolute perspective, is warranted given a certain growth rate and a certain EPS level. But we can also see what the market has typically awarded Meta. And you can see at times it's been at 50 times earnings, and 30 times earnings is more the norm than anything else. And right now we're just at 23 times earnings. Moving on to Nvidia, they are growing even faster, and especially a couple of years here. And year-on-year growth has also been phenomenal. And the market is also much more optimistic going forward for Nvidia. Given that growth, a price earnings ratio of 38 times last 12 months is really not that much. And it's arguably not as cheap as Meta, but it's definitely not expensive or in bubble theory. Actually, my back of the envelope estimate for Nvidia points to just a 15 times price earnings ratio for 2027 if my projections are correct, and that is definitely not expensive. You can also see that the market has historically awarded Nvidia with much higher valuations historically. So right now they are on a kind of a pessimistic streak, probably regarding the looming recession.